Hey gang, Kenny here. Hey, we've got a special podcast coming out today. There's some hot off the press news in the financial markets dealing with, again, index universal life. This time, it's a celebrity. Kyle Busch, his wife Samantha Busch, who's the NASCAR race car driver, they've made a claim against Pacific Life and their agent who allegedly misinformed and misrepresented their insurance product to them as a retirement product. Now, I've been using life insurance for my clients for 30 plus years, and we do use it in retirement planning, but I use a specific type of product, plain old dividend-paying whole life insurance issued by mutual companies. And there's mutual companies that I would tell you today, I always say to my clients, Penn Mutual, Northwestern Mutual, Guardian Life, New York Life, Mass Mutual. If you're not using one of those 5 mutual carriers, I would tell you, look again, buyer beware. Bottom line, check out this episode. We talk about Kyle and Samantha Busch and the specifics of their case and the alleged claims that they're making against Pac Life, and showing you some illustrations that I've seen with folks coming through my office over the last few months. So again, buyer beware, watch this episode, and as always, smash that like button, subscribe, share our podcast with folks around you. You'll be glad you did. Love you guys. Take care.
180 and we're at the speed down to 25 minutes.
Point wherever you reduce speed to 180.
Blackbox. Hey gang, welcome back to KP's Blackbox. Today I'm here with a guest host, Mr. Cody Hines.
Thank you for having me.
In front of the camera versus in the control room.
A little different.
Isaiah's out on an errand who would usually sit in that seat. So welcome, Cody.
Thank you.
And man, you are here today because we're kind of doing part 2 of talking about a specific insurance product called Index Universal Life.
Right.
And you're new to the business. You're actually credentialing some point in time in the future, whenever you pass your test. Whenever you take
very
your,
soon.
Yeah.
Very soon, yeah.
Cody will be credentialing in the business as a financial advisor. So congrats on that.
Thank you.
Spent 10 years in the mortgage business, right?
Yep.
And we whisked him away
Yep.
from one of our friends in the mortgage business. But
very exciting.
all's fair in love and war.
It happens.
Yeah. It's happened to me enough. I'm losing people to competition, so I'm like, why
Might
not?
as well.
Yeah.
Yeah, exactly. It worked out.
It did.
Yeah. It was good.
But in all seriousness, welcome. We're glad to have you at KP and Co.
Thanks for having me.
And today I just asked Cody to set in and really just kind of throw questions at me as a consumer who would be like, well, how does this happen in these financial products? And what we're talking about specifically is, I think 2 or 3 episodes ago, we recorded a show about the buyer beware of index universal life insurance. Yeah. And the reason we did, Cody, is because over the last probably 3 or 4 months, it seems like I've seen an influx of people coming into our financial office. And when we're conducting these new interviews with potentially onboarding these folks as clients of ours, many of them had an index universal life policy.
Yeah, a lot of them.
Yeah.
It was like over and over. We would see it.
And it was like singing the same song and dance over again.
Yeah.
You're like, Kenny, what is this? Why is this happening?
Like, was this on purpose? Like, did we line them all up? Yeah.
What are you trying to teach me here?
Yeah, exactly.
But, we can kind of joke about it a little bit, but in all seriousness, people were getting hurt.
Right.
And really hurt by not understanding the good, the bad, the ugly of this financial product.
Right.
I'm not here today to disparage my industry or say that they do these things on purpose, but this specific financial product has a lot of variables that can take place. And the more variables that you put into any financial product, there is a high probability that sooner or later all of those variables are going to fall in line
Right.
in a way that could hurt you really bad financially.
Yeah.
I've been doing this in my career professionally, from investment advisor to insurance agent and just a financial professional for 30 years. And I remember when these products came about 20 years ago. They look really awesome. They look really great. And I was taught just to be, a little skeptical.
Yeah.
And my skepticism has fortunately paid off for me.
Right.
Because I've only used this financial product with one client, and it didn't go well, and I'll never write another one of these products again.
Yeah.
And it didn't go well in the sense that what we thought would happen and what we thought would lay out in a market scenario of good things happening when markets go bad didn't even come close to the illustration.
Wow.
Not even close.
Right.
And so I was like, man, I can't justify recommending people buy IUL.
Right.
And I catch a lot of heat. Most of my competitors and most of the people in our industry who recommend permanent life insurance recommend index universal life insurance to their clients. I'm considered a dinosaur
Right.
to tell people to either rent term insurance or buy dividend-paying whole life insurance. And there's really 5 companies that I would tell you to buy that from. And I'll tell you today who they are. No secrets.
Right.
Penn Mutual. That's my go-to. Love Penn Mutual. Hopefully they keep up the good work.
Yep.
Now, Penn Mutual also issues an index universal life insurance policy.
They have that available.
They have it available, and if you want to buy it, you can buy it. They have variable universal life. We'll talk about that a little bit. They have universal life. So they are a product distributor. They make a product available for anybody
Right.
out there that wants to use it, and they use a distribution force of independent agents like myself and a small contingency of captive agents. But their mutuality is what I love. The mutuality means that once you buy a policy with Penn Mutual or any mutual company within reason,
Right.
I'll come back to that. When you buy a mutual policy, what they're typically going to say, Cody, is that they will offer dividends or a return of premium
Right.
or return of profits
Right.
to you.
Yeah.
And that's basically what a dividend-paying or participating whole life company. Now, there can be mutual companies who are non-participating.
Right.
Now, if they said non-participating, what do you think that means about the dividend?
That means you're probably not getting it.
You're probably not getting
Yeah.
a dividend.
Yeah.
And that's exactly right. It's probably a fixed rate that you're getting.
Right.
So what I want to do today is just, one, share a story with you. And if you're a NASCAR fan, you're going to know this guy
Right.
who bought a product, and he and his wife allegedly were duped.
Right.
And I have to say allegedly because this is fresh, hot off the press.
Right.
I actually had a client send me this text yesterday, and I had just downloaded it. And he's like, Kenny, are you seeing this? He goes, you don't know how many people are calling me going, hey, Mike. I'm not going to tell you his last name, but hey, Mike, is this what you bought? Because Mike is an advocate of the insurance designs that we use.
Right.
And he had to quickly inform them that no, actually my advisor despises,
Doesn't
and
like
I'm
it.
just not going to mince words today.
Of course.
I do not like IUL.
Right.
I get my door knocked on. I get asked to contract with IUL companies all the time. And even close relationships that I have with In our industry, it's called IMOs, FMOs, field marketing organizations, individual marketing organizations. My IMO has been on me for years. Man, you should be writing IUL. You're missing out. Why aren't you doing this? And it's because I have never found anyone be able to truth in illustration, show me an illustration that I could tell my client that they had long-term guarantees.
Right.
And even in the guarantees of the death benefit staying in force if the client pays the premium in all years.
Right.
And whatever that illustrated or premium design that was created, whatever that number is, there is a way for an index universal to stay in force if it has what's called a no-lapse rider.
Right.
And we'll come back to that more today. This is a long introduction.
Well, I mean, it's needed. It's necessary. You know,
Yeah.
we're about to get into something that a lot of people have, but we've seen it do more hurting rather than benefiting, at least
Unfortunately.
inside of our doors.
Yeah.
Yeah.
And you're fairly new to the industry. And man, you're getting baptism by fire here, seeing how some of these financial products are designed in a way that are heavily hedged in the benefit of the insurance company
Right.
and not the consumer.
Yeah.
And you have to remember that the insurance company is designed to be for profit. A stock company and a mutual company, same thing. As a mutual policyholder, I want my insurance company to be profitable.
Right.
Because if they're not, are they going to pay the death benefit to my heirs as part of my legacy plan?
Exactly.
So I need the insurance company to be in business. But man, if the industry keeps doing crap like what's happening with the Bushes, they got some trouble, deservedly so.
Yeah.
And I'm not going to mince words. I'm probably going to catch some heat for the podcast I'm going to do today.
Yeah.
I'll take it.
Thanks for having me with you on this.
Yeah.
Before we get too far into it, you said there were 5 companies that you trust and that you liked working with. What were those 5 companies?
Yep, there we go. The voice of reason.
Yep.
That's Jacob in the studio, folks. Those 5 companies, I said Penn Mutual, and I got on a rabbit trail there. I apologize. Next in line, I would say Northwestern Mutual, Mass Mutual, New York Life. I'm missing number 5. Penn, Mass, New York.
Say North American? Or
No,
not a mutual
they're
company?
not a mutual company. They're good on the FIA side, the fixed index side. Who am I missing? Guardian Life. Holy cow. I started my career with Guardian. So Penn Mutual, Northwestern Mutual, Mass Mutual, New York Life, Guardian Life, and in no specific order.
Right.
I'm favorable to Penn because they've been at the top of their game the last 10 years.
Right.
But if I see a policy come across my desk that's a plain old dividend-paying whole life insurance policy, rarely do I tell a client with those 5 companies to get rid of it or
Right.
do something different.
Yep.
It does happen even with Penn Mutual policies because design is everything. If it's not designed appropriately or the way you were under the impression that it was supposed to be designed,
Yeah.
it can still blow up on you.
It can hurt more than it helps.
Right.
Yeah.
So one of the features of whole life, Cody, that's really, really important for people to understand is what's called the non-forfeiture clauses. And these non-forfeiture, what do you think that means? If it's non-forfeiture,
it won't forfeit. It
right.
won't-
So what
yeah.
are these things that you don't have to give up?
Right.
Well, there's a big one that's unique to whole life insurance, dividend-paying whole life insurance. And one of those non-forfeiture features is what's called a reduced paid up. I use it often with my clients. The reduced paid up says, consumer, you've paid in all of these premiums. And if you've paid in all of these premiums, we will give you a non-forfeiture right to never have to pay another premium again contractually guaranteed.
Right.
As long as the insurance company stays in business, this non-forfeiture right means that that policy could be reduced. So if you think about, let's say if you have $1 million death benefit,
Right.
and based on the premiums that you've paid into this whole life contract, that death benefit could be reduced based on the amount that you've paid in, the number of years that you've paid in. And let me put little asterisks here. If you pay the first 6 years of an insurance premium, most of the time you do a reduced paid up, that's going to trigger a tax event called a MEC.
Yeah.
MEC stands for Modified Endowment Contract. The rules for Modified Endowment Contract have changed over the years. The big rules changed in 1983 and 1986 under two tax acts, the TAMRA-DEFRA tax acts, and those acronyms I can't remember. You can fact check me, Google check me.
Yeah.
As a matter of fact, do that, Jake. Look up TAMRA, T-A-M-R-A, DEFRA, D-E-F-R-A, and it'll remind me of what those acronyms mean.
Right.
But those govern how premiums go into an insurance contract. Internal Revenue Service, Treasury governs that.
Interesting.
And they regulate the insurance company's design of policies with those regulatory guidelines. There you go. It's right there, right up front. Did you bring it up here on the screen for us? So with my poor vision these days.
I know. I'm about to need some glasses, new glasses.
Yeah, so TAMRA, we used to call them the ugly twin sisters. It's the Technical and Miscellaneous Revenue Act of 1988. This act built upon previous legislation like DEFRA, or Deficit Reduction Act of 84, and it established what's called the 7-pay test. Now, Cody, you've helped in administration in this, and you've probably seen that in the illustrations, right?
Yeah.
Talking about the 7-pay test.
Yeah.
So the 7-pay test is the rule that limits the amount of premiums that can be paid into a life insurance policy simply within the first 7 years to maintain its tax advantage status. So what you hear being purported by agents and financial advisors, which is not dishonest, but you'll have agents say, hey, life insurance is income tax free.
Right.
And it is, if you meet regulatory guidelines.
Right.
But if you only go 6 premium payments in most cases, there are some little outliers, and I don't have time today to go through those.
Right.
But if you only paid 6 premiums and you did a reduced paid up, you've now turned the policy into a MEC. And I've had some clients do that. As long as they're okay and there's willful acknowledgement and
Right.
understanding of what they're doing and the consequence of that, no harm, no foul. The death benefit will still be income tax free.
Right.
The cash value up to its basis can be income tax free. But if you want to take money out of that policy, it does trigger taxable events.
Right.
So it's not always income tax free.
Right.
A better way to maybe talk about it would be like tax preferred
Yeah.
versus tax free.
Yep.
But if you follow the rules, life insurance for the beneficiary, life insurance for the owners can be income tax free.
Right.
Meaning there are 2 ways money can be tax free for you in a life insurance policy, and only 2 ways. That is, if you're borrowing money out to your basis, okay, or distributing to your basis. There's a difference.
Okay.
If I take a distribution and I go reduce my policy by taking out my basis, that's going to reduce the face amount, the death benefit.
Okay.
So if I take my basis out, when you pay for life insurance, most of the time you're going to pay for it with after-tax dollars, like you would contributing to a Roth IRA.
Right.
So if you take your basis out, Cody, there's no income tax on that.
Yeah. Makes sense.
Under life insurance provisions in the Internal Revenue Code, it also allows you to borrow money out. So the IRS does not tax you on money that you borrow. It's a loan.
Right.
Well, a lot of agents out there will say, well, when you take a loan against your policy, you're borrowing it from yourself.
Yeah, I've heard that before.
I'm like, okay, that's not entirely true.
Right.
Let's explain that. If you take a loan from your life insurance policy, the insurance company is placing a lien against your cash surrender value and loaning you their money.
Right. Right.
They're
Makes
loaning
sense.
you their money.
Yeah.
If you say something twice, you should
Write it down.
write it down, pay attention. I'll say it 3 times. They're loaning you their money with a lien against your policy. Okay? So you're not borrowing from yourself. You're borrowing from the insurance company with a lien against your policy.
Right.
Now, these loan rates are very favorable inside of insurance contracts most of the time.
Right.
As an example, today, you can borrow money from your Penn Mutual Life Insurance contract, and the current loan rate's 5.3% as of the publication of this podcast.
Right.
That can change as interest rates go up and down. It might actually go down a little bit since the Fed rate just dropped by 25 basis points.
Right.
So when the dividend rate is higher than the loan rate, that can be preferential borrowing, meaning there's a potential for you to have the opportunity for that dividend to offset the loan
Right.
if you chose not to pay it back. But it's still going to reduce the dividend or reduce what's accumulating in your life insurance contract.
Yeah.
But there are different loan provisions when you pay back a loan. It's the only loan that I'm aware of that's not reported to the credit agencies.
Yeah.
So if you borrow from the insurance company with a lien against your policy or borrow from yourself,
Yeah.
then that policy isn't reported on your credit report.
Right.
So it's not an additional liability. You can also, Cody, decide when you want to pay that loan back and at what terms you pay it back. The insurance company says, we're going to charge you simple interest on that loan each year.
Right.
So each year that a loan is outstanding, using that number of 5.3%, you're going to pay that loan interest to the insurance company some way, somehow. It
One
ain't
way or another.
free.
Yeah. Exactly.
So understand that. And as long as there's an understanding of that, you're in a better shape than most people out there. I would say 90% of the people out there don't understand that.
Yeah.
And I'll be as transparent to say this. There's probably even some of my own clients who still get fuzzy on that
Right. Right.
because I'm the expert and they're the consumer. I know most of the rules and most of the nuances. I won't be as audacious to say I know it all.
Right.
I'm always learning. But inside these insurance contracts, I have a good to great understanding, a 30-year understanding of how they work.
Yeah.
I have never, ever, ever in my career had a whole life contract go the wrong way.
Right.
Or me have to go back and apologize to my client that it didn't work out the way we planned.
Right.
Or the way we strategize. Dividend rates can change because guess what? Dividends are not guaranteed in a whole life contract. However, those 5 companies I told you about, they have in some cases, 200-year track record
Wow.
of paying dividends and never missing.
Wow.
So Penn Mutual, since its charter, has not missed paying a dividend to its policyholders.
Incredible.
170 some years now.
Right.
Never missed paying a dividend. That's unheard of.
Right.
Now, what we're talking about right now is plain old dividend paying whole life insurance. I could do a whole podcast on that, but I wanted to set the basis that what we're talking about today is not whole life. It's not dividend paying. It's called index universal life. And the last podcast I did, what episode was that, Jake? Can you look back real quick and tell us?
It released last, I think it released on Monday.
Okay.
Yeah.
So we'll find that episode for you in a minute. But on that episode, we talked about these IUL policies and how dangerous they are if they're not properly funded.
Mm-hmm.
So again, today I'm not disparaging my industry saying that all IUL is bad. I'm saying buyer beware that the agents who are designing these may not know what they're doing.
Right.
It sounded like in the Busch's example that agent had no clue, and Pacific Life allegedly just let it fly,
Right.
and that's unfortunate.
I think the key word that we're going to hit on for the rest of this podcast is just understanding
Mhm.
what you're getting into, understanding the ins and outs.
So before we go deeper, I'm going to play an Instagram of Kyle and his wife, Samantha Busch. And this is fresh off the press. Mm-hmm. This is hot off their Instagram page. They have filed a lawsuit alleging claims against an agent. His name was Rodney Smith, I think it is. And they alleged a complaint against Pacific Life. And the reason I want to talk about it again today is because even though it's alleged, and I have to say it alleged because it hasn't been proved yet,
Right.
what they are saying is what I hear over and over again from consumers who have bought these products.
Right.
And then it appears to me, Cody, they went even a step further and financed their premiums, meaning they used a strategy that's typically used in estate planning, not in retirement planning. And there's a difference to fund these policies.
Right.
Premium finance is a big boy game. I've got a few clients who have done it. I've got a few clients who are premium financing now. You have to be aware. You have to be educated. And it's your job to be understood, not misunderstood as an agent. And they still can be somewhat complicated even when they're properly structured.
Right.
Because interest rates change, rules change, and these variables can just eat away
Yeah.
at a contract. So let's hear from Kyle and Samantha real quick.
We are in New York City. Samantha and I are at one of the major news stations here in New York City. And as many of you may have seen, we have a press release out that we are in litigation with Pacific Life in regards to IUL policies and insurance policies that are also retirement policies for planning for our future. And unfortunately, ours did not go well.
Yeah, as you'll hear when this broadcast comes out, it was a major scam. We tried to do what we thought was best for our family, for Brexton and Lennox. We were trying to be financially responsible for them and plan for our future. And little did we know that by investing money in this scam, it's all gone. And so the reason we came out here today is, as you guys know, who've followed us for a while, every time God puts a struggle in our path, we're going to try to use it for good. And so we're out here speaking out about what happened, because this just isn't happening to athletes and celebrities.
Right.
This is happening to teachers, police officers, veterans. This is happening to widows. These are people who are 70 years old. They have nothing else to fall back on. These are people who are, they've worked hard, they've made a small business, they are ready to retire, and they buy into these scams and they lose absolutely everything. And so, Kyle and I will use this platform to try to do all the good that we can. And so we're gonna keep fighting Pacific Life, and we're gonna show the world that this was a huge and utter scam.
That's right. So tune in for further updates as we come along further in the case. Here we are in New York.
Okay. So I feel for Kyle, and I don't know them. I don't know the agents involved. I'm familiar with Pacific Life. I've never used any of their insurance products,
Right.
life insurance products. They used to have some decent annuity products way back in the day, but not even on the annuity side, because they're just kind of littered in some of this alleged scams, is
Right.
what Samantha called it, or Miss Busch. I don't know her. Samantha, whatever. Now, I've listened to this again, and one of the things that kind of resonates with me, Cody, is that I don't want to go as far as saying this is a scam.
I was going to ask you that.
So, I mean, that usually means that the intent was to deceive and lie and cheat. That's not the way these products are designed.
Right.
They're not designed to do that. They're not designed to cheat you. Pacific Life is not this big, mean, nasty organization who's just out
Ripping people
to
off.
rip people off.
Right.
No way. Now, I don't know the agent, but there have been a lot of agents that have been convicted of doing unscrupulous, bad activity.
Right.
Right. So that again is what you have a responsibility to look up a person's background and see, you know, do
Who
they
you're
have
going
any of
with.
those
Yeah.
bad marks? And just because a person has also made a mistake in the past doesn't mean that they're not redeemed or have an ability, but they should be able to discuss that with you
Right.
and tell you their side of the story, and then you make a decision whether or not they're a good fit for you to work with.
Yep.
And it's important to understand, are they doing what's in your best interest?
Right.
And are they putting you, the client, ahead of their own interest? And if the agent's doing that, or if a fiduciary is doing that, you're in good shape. You're probably going to be okay. Now, here's the facts of the story. I pulled this down off the press this morning. So NASCAR driver Kyle Busch and his wife alleged that they were misled into purchasing a complex index universal life insurance strategy marketed as tax-free retirement plans. And I would concur that gets marketed a lot, that you've got this tax-free retirement. And there should be little asterisks by that it could have been tax-free. The Bushes claimed they paid $10.4 million in premiums and now face $8.5 million in losses after discovering the plan's projected benefits were based on unrealistic assumptions.
It's wild. How does that happen? Like how can you put in so much, lose so much, and be stuck with two left over?
Yeah. So in their specific case, from all the research I've been able to do so far, it appears to me that the Bushes didn't use their own premium, number one.
Yeah.
It appears to me that they did a hybrid purchase using a technique called premium finance that we talked about a few minutes ago. In premium finance, they borrow money to pay the premium of the insurance contract. The bank or the lender who loaned them the money puts a lien against the cash surrender value of the policy. So now you have the carrying cost of the loan.
Right.
And then you collateralize your policy to pay that loan. And in many cases, there's double and triple leverage in the mindset that the Bushes allegedly, I don't know this for sure because I haven't seen the details of their case.
Right.
They probably borrowed the money to pay the interest on their policy as well. So the out-of-pocket costs to the Bushes, they're saying here in this claim that it was $8.5 million. So there's a $2 million delta.
Right.
They paid in 10.5. They're out 8.5. So there's still $2 million in cash. That kind of lends itself to me to say there's still some cash surrender value, but the values were being eaten up by the fees and by the loan interest,
Right.
by the cost of insurance, and by the underlying, I don't know if there were any fees or riders. Again, I don't know the details here. But that's what matters when you're funding these policies is understand the details. And as I said in the very beginning of the podcast, the more variables that you put into any agreement,
Right.
the more opportunities you have for things to go wrong, or AKA for the wheels to fall off the bus.
Yeah, definitely.
So here's key allegations. there were misrepresentation and omissions. The agents allegedly illustrated double-digit returns. I've seen that happen before, so I could look at that and go, well, I've personally seen where agents have illustrated double-digit returns
Right.
and did it for a lifetime. And their argument is that, well, the S&P 500 over the 100-year average has done like 11.3%. Why wouldn't I use double-digit returns? Dave Ramsey tells everybody that they can get 12% in their mutual fund.
Right.
And I'm like, holy shit, guys, will you stop
Right.
with the BS?
Right. Just be straight up.
The likelihood of that happening where you have the fees involved nets that return back. And the idea of that happening blows me away. And this is why I want to show you an example on a smaller case where misrepresentation by a company happens. I'm going to pick on Transamerica right now because this is the last illustration we did in the podcast.
Right.
I'm going to bring that back up. Jake, if we can bring that up. And I'm not alleging that Transamerica is doing anything wrong. So all you Transamerica agents, don't go report me
Just
to
relax.
the Transamerica police that
Right.
I'm disparaging your company. I'm not. It just happens to be an illustration that we got. This is called an in-force illustration. We redacted the client's name. And what I want to show is that how the in-force illustration was ran, Cody, which is probably what happened to the Bushes.
Right.
I want to show you something that happens. And read your illustration. So let's read right in the middle of this page. In bold, dark ink, all capitalized. This is an illustration only. An illustration is not intended to predict actual performance, interest rates, dividends, or values that are set forth in the illustration are not guaranteed, except for those items clearly labeled as guaranteed. So what do you think that says? This is like in Bible class where we're trying to interpret
Right.
Scripture here. What the heck is this saying, Cody?
I mean, obviously you can tell me if I'm wrong, but
I promise I will.
yeah, or I'll just cut it out. No, I'm just kidding. I mean, it just seems like it's a protection clause. Like, hey, some stuff, like you have to actually dig in and read to see what you're actually going to get.
Exactly right.
Yeah.
So index universal life insurance is not a security. So you're not buying the underlying security in an index universal life policy. You're mirroring the index.
Right.
And we can go spend a whole podcast on, well, how does that work and how do they mirror the index?
Yeah.
Look, I don't want to bog down on that today. We'll do another podcast
Part 3.
to break that up.
Yeah.
But index universal life insurance policies are not an investment in the stock market or the indexes. Index account interest is based on, in part, on an index performance. Past performance of an index is not an indication of future index performance. Past performance is not indicative of future performance. That's true
key.
in your traditional investments.
Right.
If you're buying stocks, bonds, or mutual funds, no one in their right mind would ever tell you there's a guarantee.
Right.
If they are saying that to you, run.
It's
They're lying. Hire a new advisor. There is no guarantee that any excess index interest will be credited above the guaranteed minimum interest rate for that index account. That's one to point out and come back to. Additionally, there is no guarantee that the company will declare an interest rate greater than the guaranteed minimum interest rate for the basic interest account. What is the basic interest account versus the index account? We'll have to come back to that in a few minutes. Depending on your state of issue, life insurance is issued by each state, not by a federal regulatory guidelines. It's insurance at the state level. That's the same with your car insurance, your homeowners, liability insurance. Insurance is regulated at the state level first. Okay. Your policy may be an individual policy or a certificate issued under a group policy and is subject to the state's insurance laws, and regulations. All state-specific policy features will be described in your policy. All right. So you got the
Overview.
overview.
Yeah.
We got the large print. and the bold print. So
Yes.
let's go start breaking this thing apart. On the next page, you're going to see policy definitions of the basic life insurance illustration. So there's things like the name of the policy, and it's whatever it's called. All these insurance companies come up with weird. This is the WRL Freedom Equity Index UL trademarked.
Sounds so
Form
fancy.
whatever EIUL 010305. That's that specific product that they submitted to the state, and the state said, okay, this is an approved policy,
Right.
or you're allowed to market this policy in our state. Then there's death benefit option. Death benefit option in an IUL, UL, and variable universal life, it can increase or it can stay level. Okay, that's important to know because depending on which one you choose, creates additional cost.
Right.
If it's increasing, what do you think happens to your costs over time?
It's going to go up.
It's going to go up.
Yeah.
Just keep that in mind. The death benefit. So let's read this. In this particular case, this life insurance policy provides a level death benefit as it's described in the policy. The death benefit is to be paid to the beneficiary upon the insured's death. The death benefit is assumed to be $605,000 in this case, is what this client bought, not from me, from some other agent. The actual amount payable at death may be decreased by policy withdrawals or any loan balance, or, it didn't stop there,
Right.
increased by additional insurance benefits you purchase. So it can go down or it can go up. By the way, we will adjust the amount of the payment in accordance with any attached rider, subject to its terms. The death benefit column shows the value if paid upon death at the end of the policy year. And then the specified amount. Any amount used to determine the death benefit, the policy owner may increase the specified amount after the first policy anniversary. Decreases are available only after the third policy anniversary. So if you want to change your death benefit and make it go down, they're not going to let you do it until end of policy year 3
Right.
in this particular case. So it's important to know, well, what's the features of those? And most of the time, if you're going to go up in death benefit, usually most companies require new evidence of insurability for you to increase. This particular policy, and again, this is not like the Bushes here where they were putting $10.5 million in over some specified period of time, which I don't know the answer to that. But in this client's case, the premium outlay is the amount of premium which is planned to be paid during the lifetime of this policy. During the lifetime of this policy.
Right.
The current year premium outlay is $3,600 a year in this case. The amount of premium that may be paid is subject to any applicable limits set by Section 7702 of the Internal Revenue Code, which is part of that TAMRA DEFRA that we looked at earlier.
Right.
So there's an entire revenue code for insurance and annuities, Section 7702.
Right.
Now, as we go through this policy and we look at these terms and conditions, this is something that's unique to universal life, which is no lapse. Your illustrated minimum monthly no lapse premium is $3,587.64. So that's the minimum. They're saying that if you pay that in all years, your policy won't lapse. Okay?
Yeah.
Most of the time, here's what happens though. Agents are illustrating that they're cutting the premiums off maybe 10 years, maybe 20 years, maybe 30 years. But the guarantee says that if you want to keep that $605,000 death benefit, you have to pay the minimum no lapse premium. But let's read on. No lapse premium is the minimum premium necessary to avoid a lapse of the policy during the no lapse period. During the no lapse period, regardless of the cash value. The premium will be calculated for each policy issued. Policy and rider changes will alter minimum monthly no lapse premium. Are you confused yet?
Yeah, it just seems like there's a lot of words that are
Yeah.
creating a lot of gray area.
Under certain circumstances, extra premiums may be required to prevent lapse, even in a no lapse. Huh? What the? What the?
Yeah.
All right, so then there's bold print, no lapse period. Issue ages 0 to 60.
So long.
Huh?
Yeah.
What does that mean? Ages 0 to 60, or the lesser of 20 years or until age 65. And then issue ages 61 to 85, or 5 years. All right, so now they're saying during the no lapse period, the policy will not lapse even if the net surrender value on any monthly policy date is insufficient to pay the monthly deduction due, as long as the premiums paid, net of outstanding loans and withdrawals,
Right.
meet or exceed the cumulative monthly no lapse premium requirements to date. But if you take a loan or if you take money out, all bets off,
Right.
no lapse,
For-
out the door.
Yeah.
I'm going to skip down. After no lapse period, if the cumulative monthly premium, no lapse premium requirements are not met, then fluctuations in interest rates and or policy charges may require the payment of additional premiums. So that seems to be a reoccurring effect.
Right.
You may have to pay some more premiums than that no lapse premium. No lapse guarantee. Let's hone in on that. The payment of minimum monthly no lapse premium assures the policy will remain in force during the no lapse period. And we go back up and we look at no lapse period, issue ages 0 to 60, and then 61 to 85. And remember those ages because we're going to go back and look at the illustration here in a bit. So the specific amount will be guaranteed regardless of cash value during the no lapse period, provided the cumulative minimum monthly no lapse premium requirements are met. And then they're going to get into account options. Well, here's where you can put your money, Mr. and Mrs. Client.
Right.
You can put it in the basic interest account and earn a basic flat rate,
Right.
or you can put it in the equity index account, and maybe we'll let you blend a portion in each. So actually they say that. You may select the percentage of net premiums to be allocated to each of the accounts. Net premiums. So what is net premiums?
Right. Now they're bringing something else in.
Okay. The cash values is the illustration are based on the illustrated premium allocations indicated below. If net premiums are allocated differently than indicated, or if transfers are made, then the cash values will be different than those shown in this illustration. So which means the illustration could be right or wrong depending on if you make some changes. All right, so we got through all those definitions, and are you as clear as mud right now on what you just bought?
Yeah. Definitely clear as mud.
Clear as mud, right? And so are you out there. I get it. But this is what language is laid out in Index Universal Life.
For just the regular consumer.
Regular consumer.
Yeah.
And it's supposed to be put in plain language that you understand. But we got a lot of definitions right now that we got the minimum monthly no lapse premium. We've got a no lapse period. We got a no lapse guarantee.
Right.
We got these death benefit options.
Issue ages and
Specified amount, premium outlay, net premiums. So
they need like a definition page for the definition page.
yeah,
Essentially.
they kind of do that.
Oh, okay.
So let's go to the next page, Jake. Next 2 pages. All right, so here's your basic interest account, Cody. Illustrated premium allocations. The basic interest account, 0% of premium, and this illustration is going there. So the illustrator is saying that 100% of this client's money, $3,600 a year, went into the index account. For the Bushes, I bet they did the same thing.
Right.
They put all of those big premiums into the index account because the agent said, hey, look, stock market's going to go up. When it goes up, you're going to get all of the upside or some percentage of the upside, participation rate.
Right.
But if the stock market goes down, Cody, and let's say we're in the S&P 500 index, mirroring that index,
Right.
If it goes down, guess what my product does for you? It blocks you from losing any money.
Well, that sounds
Well,
nice.
losing any money?
Right.
Like, no, I can't lose any money
Right.
in the index account. Wait,
Doesn't. Yeah.
well, you should say, what do you mean
Yeah,
in
what
the
is
index
that?
account?
Yeah.
What about the rest of the account? What
Right.
about everything
What
else?
about-
Okay, that's where I'm coming now to monthly deductions, surrender charges. So a monthly deduction is each monthly deduction consists of monthly cost of insurance, COIs, you'll hear it said. The monthly policy charge, the per unit charge, any charges for additional benefits provided by riders, and any charges for substandard premium class rating.
A lot.
Okay?
Yeah.
You clear yet?
I guess.
Oh, and then there's some surrender charges will be applied upon full surrender within the first 10 policy years and then for 10 years from the date of any specified amount of increase. So if you increase it, we're going to add another 10 years. If you just keep everything the same, the first 10 years subject to surrender charges. So we got loan balance, we got policy loans, we got net surrender value. Let's talk about the loan balance for a minute.
All right.
So the Bushes, I allege, used premium finance according to the summary of the lawsuit we pulled off the internet here.
Mm-hmm.
So remember, they borrowed money from some other institution
To pay.
to pay this premium.
Mm-hmm.
So that's an interest cost.
Right.
And then inside the policy, if there was any money being moved out,
Mm-hmm.
loan cost. So policy loans, loan balance. Loan balance equals all outstanding policy loans, if any, and accrued loan interest. Loan balance decreases the death benefit and the net surrender value. Policy loans are taken from the basic interest account first. Okay, that's call it the fixed account, until exhausted, and then from the index account, which is where your equity index mirroring goes on. Loans are taken from the highest numbered segments first. The amount of cash value equal to the loan balance will be credited with an annual interest rate of 2%. Loan balance will be credited with an interest at an annual rate of 2%. But that seems kind of cool.
Yeah, that's not bad.
Nebulous, right?
Right.
It's better than nothing, right?
I'll take 2%.
But here's the policy loan. The maximum loan interest rate on an outstanding loan balance is 3%, with a maximum preferred rate of 2.25 charged in arrears.
The layers.
The preferred interest rate is charged on amounts in excess of premiums paid, less withdrawals, and outstanding loans, including interest. Preferred rates are available after the 10th policy year. So the first 10 years, you got to deal with some extra costs.
Right.
This policy has a rider on it called the terminal illness rider. And this is basically a rider. It's a good rider. This rider allows for the one half of the death benefit to be paid to the insured or to the owner
Okay.
and insured if they're the same person. Usually up to about one half of the death benefit while they're living. So riders can cost you money. This particular rider on this policy and in most policies issued has no cost.
Right.
It's because Congress said back in 2008 they wanted insurance companies to allow for like a chronic illness rider, which is like long-term care,
Right.
and a terminal illness rider to be issued on policies after 2008 with no cost to the consumer. So I'm not sure why it doesn't have a chronic illness rider. That can be something that maybe in Transamerica they just didn't offer and wouldn't
Right.
put in their policy. So not sure why the chronic is not there. All right, let's go to the next page. There's some definitions here, but I want to get into non-guaranteed elements and guaranteed elements. So, question, Cody?
No. I was just seeing if that's what we were looking for right there. The non-guaranteed projections.
Okay, guaranteed projections down at the bottom of this page here. The guaranteed projection columns, and again, I'm giving you this over again, folks, because of what's happened with the Bushes.
Right.
This is pretty much what the Bushes were looking at. Even though Transamerica, Pac Life, they're two different companies.
Yeah.
This is pretty standard language
For the product.
Yeah.
Yeah.
So guaranteed projection columns assume a guaranteed minimum interest rate of 2% for the basic account, 1% for the equity indexed account. Okay, so what they're saying too is if you're in that guaranteed interest rate account or the basic account,
Right.
you're going to get 2%.
That's not bad.
So, I mean, during the early 2000s, if we were getting a guaranteed 2 on fixed money, that was pretty good.
Solid. Yeah.
Now, from 2000 to 2009, guess what the S&P did?
What?
Negative 0.95%.
Yeah.
So in that 10-year period, how much money do you think I made in my index universal life? We're going to find out here in just a minute.
Yeah.
All right. So future policy values and benefits are based on the payment of premiums as illustrated and benefits as requested. Non-guaranteed projections. The non-guaranteed projection values and benefits shown under this policy heading are based on non-guaranteed rates and charges. The non-guaranteed values assume that the currently illustrated non-guarantee elements will continue unchanged in all years. Since this is not likely to occur, nor actual results may be more or less favorable than those shown, non-guaranteed elements are subject to change by the company. Additional premium payments may be required to keep the policy in force or to achieve desired results. Interesting.
Yeah.
All right, now let's go look at this performance. Here we go. The S&P 500 index account will never be credited less than the guaranteed minimum interest rate or floor and has the potential to be credited with excess index interest upon the current cap. So when you read that as a consumer, Cody, and you're not licensed yet, you're not
Right.
an expert in this business, but when you read that, help me understand you as a consumer. You're reading it. What do you think it means?
It will never be credited less than the guaranteed minimum interest rate or
All right,
floor.
look right below that. What's it say?
It says what? The rate's 1%. Current cap is 7.5.
Guaranteed minimum interest rate of 1.
Yeah.
Current cap of 7.5.
So I'm never gonna get less than 1, right?
Okay.
Is that, and then has the potential to be credited with excess. So I guess I have the potential to get to 7, right? 7.5.
Or
Is that
okay? So the cap, the
Right.
current cap. What does that mean to you?
that's as high as it can go, right? Capped.
You capped.
Yeah.
Yep.
Can't get any more than that.
So if the index does 30,
I'm getting 7 or 7.5, right?
7.5.
Yeah.
Yep. That's going to be credited. And remember when they were talking about premium,
Mm-hmm.
the net premium?
Right. Right.
So what's netting the premium down? Fees and expenses, right?
Yeah.
Cost of insurance,
Yeah.
loan interest.
All those things that they listed.
Yep.
Yeah.
So we're getting a guaranteed on the net interest, the net premium of 1. We're getting a current cap of 7.5. So if we look at the S&P 500, and they're going to show us this 25, 20, 15, 10, 5, and 1 year look back. Okay? So they're going to look back at the S&P 500 and tell us how this product would have performed.
Right.
Okay?
Yep.
So there's some truth here. They're being full disclosure here,
Right.
but you have to understand what it all means.
Exactly.
All right, so let's read the italics print here. Cody, it's hard for me to see over there. Read the historical index look-back periods.
Yep. It's
Oh, Jacob. Jacob's trying to help me out there. Come down. No, other way. Other way. Right there. Here we go.
all right.
Read away.
The look-back periods are for illustrative purposes only. The IUL policy was not available during all of the time periods shown. The caps are subject to change at the discretion of the company and will be different over different time periods. A lower or higher cap would produce different hypothetical results. Further, index changes measured on different dates would produce different hypothetical results. The average index change shows the geometric averages of 1 year historical index changes, excluding dividends.
All right, stop there.
Excluding.
The S&P 500 growth, excluding dividends. So when you exclude the dividends from the rate of return, what is that going to do to the rate of return?
Is it going to drop it?
Drop it.
Yeah.
It's going to drive it down, which means that the rate that you're going to be indexed to or capped at is the growth of the S&P, not growth plus the dividends. Important to know.
Right. Okay. So excluding dividends, ending December 31st for each year during the time period shown. Average index change using cap and floor shows the averages that would have resulted from applying the policy's current cap and floor to the index changes for the same time periods. Monthly deductions and other policy fees and charges are not taken into consideration. Past index performance is not an indication of future index performance.
How many times have we read that on these 4 or 5 pages? A bunch.
A bunch, yeah.
So now let's look back at this policy. So we're capped at 7.5. So let's go do a 25-year comparison from 1999 to 2024. The average index change was 5.71%, according to this illustration, excluding dividends.
Right.
The average index change using the cap and floor was 5.13. Oh, wow. That okay. That seems like we stayed on par with
We're close.
index growth.
Yeah.
20-year, 2004 to 2024, the average index was 8.22 in its change, but the average index change using a cap and a floor was 5.53. And they've got a little arrow under that because that's what they use in the illustration was a 5-year look back. Was a 20-year look back at 5.53. But what's interesting in this, you're going to see this in a few minutes, Cody. When the agent sent them the in-force illustration, guess what the assumed rate was that the agent used?
I don't know. What, 8?
Well, you would what should he have used in your opinion, just your personal non-licensed opinion? What should he have used if you were wanting to see the real 20-year look back?
I don't know. I guess the lower, right? Or
5.53.
yeah, that's what.
If that was the 20-year average, why didn't you illustrate 5.53?
Exactly. Yeah.
Guess what he illustrated?
The 8.
6.25.
Oh my goodness.
Almost 100 basis points, 1% more than what it actually did over the last 20 years.
It just gives false hope.
Yeah.
Yeah.
And the 1-year performance, 2023 to 2024, the average index during that period was 24%. And he goes, well, look, hey, it's 7.5. You would have got credited 7.5 this year.
Right.
True. That's true. That's good. I'm glad that's happened. But when I go back and look at a long-term performance, and past performance is not indicative of future results,
Right.
but how many times over the last 20 years did the market earn 24? Let's go look according to their chart. I see that it earned 24.
Yeah.
right there on that left column, Jake. So bring the arrow down. So there's the last 2 years. There was 2021 was 3, 2019 was 4, 2013 was 5.
6, I think.
That's it.
Yeah.
5 times out of 20 years did the market do over 24. So less than a quarter of the time did the market do over 24. How many times did it do over 10? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13.
Yep.
So 13 out of 20 times it did over 10.
Right.
So you would think, well, man, we should get that 7.5 credit.
Right.
Well, we did. If we're using that as the current cap, 13 out of 20, and instead of getting 8.22, you were credited 5.53, with 13 of those times being 7.5. Let's look at the negative periods. 2008, the S&P did 38, and this is what a lot of agents hone in on.
Right.
Mr. and Mrs. Client, during the housing crisis of 2008, you lost 38.49% of your S&P value. Man, you remember that? Do you remember how horrible that was?
Right.
Do you remember the panic that ensued?
But
In my product, Mr. and Mrs. Client, you got one. You got a guaranteed one.
Yep.
That's a 38% swing in your portfolio.
Starting to sound good now.
Yeah.
Yeah.
So, man, oh, wow, that's got to be, meaning I kept my value.
Right.
Well, let's go look at the illustration of this. Let's go see what happened. So, Jake, bring us over here. Here's this person, and we can only look forward now,
Right.
all right? These are the guaranteed projections. Remember what they told us the guarantee was? Remember? You got to go back now and go, well, what's guaranteed to happen? I'm going to keep it real simple for you. What's guaranteed to happen is your policy is going to lapse. So he pays this premium out to 69 years old, 38 years of premium payments. He's put in $136,605.
Wow.
And he wakes up on his 70th birthday.
It's all gone.
Gone.
Wow.
Gone. And it was death by 1,000 cuts. We can see at the beginning of the 49th year of age, his 18th year in the policy, he paid in $64,000. He's made a whopping $7,000 of interest on that 6,100. Does that feel like 5.53?
No.
Doesn't feel anything close to it, does it?
No.
So this is guaranteed, and most agents are going to beat me up and go, Kenny, it's not going to ever hit its guaranteed rate.
Right.
That's not going to happen, dude. Stop stirring people up. Stop getting them upset. Okay, let's go to the assume page.
Right.
Jake, take us there, please. All right. So non-guaranteed alternate projections. We need to be on the left side of the page here. Okay. Now, at the 49th year, 18th year being in force, we see a premium outlay of $3,000. Why not $3,600?
I don't know, actually.
Okay, so he's already made 2 months of premium payments.
Okay.
So it's only showing that he's got $3,000 more to make.
Right. Okay, that makes
Assuming
sense.
he's putting $300 a month in.
Okay.
All right, so this policy is assuming a 6.25% rate of return. Okay, we took a little break.
Yep.
My eyeballs were floating, sorry.
That's okay.
So what we were saying here is that this couple, or this individual, bought this policy and has paid premiums, and we're going to assume that he's going to do this, that he's going to pay these premiums out to 78 years young, so 47 total years, but from 49 to 78, That 40-year period is what we're going to examine. And we're going to compare the market to this policy and see if we even come close. Now, remember we said earlier that the 20-year average on this was 5.53.
Right.
The agent, when it ran the illustration, the in-force illustration, they ran an assumption at 6.25,
Right.
not 5.53. So there in and of itself, for me, is a problem.
Right.
Why didn't you run the illustration at what the 20-year average was?
Why would you run it higher?
Why would you run it higher?
Mm-hmm.
So this person at the end of age 78, the 47th year of the policy, they're showing that there's $179,565 of cash in the policy for a $605,000 death benefit. And it's still in force at 78. But we're going to jump over to the 89th year. And what do we see happen here?
It's gone.
Lapse, folks. Gone. And what you will hear agents say is, that's not going to happen. That's not even close. Won't occur.
Yeah.
Well, it's occurring guaranteed. And even in your non-guaranteed with
it's showing up.
6.25, it's still showing up. I'm a little nervous.
Yeah. What do we?
Well, let me show you what should have happened had you had exposure to the market.
Right.
And Jake, let's bring up the software. So here's what we did, folks. We took $72,846, which was his current cash surrender value. And from 49 to 89 years old, we did that 40-year period. And we assumed he was still making $3,600 a year premium payments. Now, what you're showing here, Jake, is the S&P 500, including dividends, and you did this starting in 1928. So you put this person in the Great Depression.
Yeah.
All right?
Really
right
bad.
before the Great Depression, the S&P did 43%.
Right.
But look at the net. I want to look at the net return. So the net return was 10.32. The mathematical average was 12.04. And the stark difference over to the far right, the net result, $5,599,150 compared to, what was the number?
It was like
605
Yeah.
or 0.
Mm-hmm.
Okay, now I'm going to have a lot of agents, like, well, Kenny, that is not the right way to illustrate this. You can't do that. Okay, all right,
Fair enough.
calm down.
Right.
So let's go in and illustrate this the way they illustrated it.
Mm-hmm.
Let's assume there's a floor of 1,
Mm-hmm.
okay?
Yep.
And Jake, just by the way, let's go from 2024 back 40 years. And so that would be 1975. Yeah,
Yeah.
try that. So the market averaged 11% over that period. You got $8 million, $9 million in your portfolio, 9.7 on $3,600 a year.
Wow.
Can you imagine why the Bushes are upset?
Yeah. Oh yeah.
Kyle and Samantha Busch,
Oh yeah.
why they're upset? This is probably what was illustrated to them. That this is what's going to happen in your policy with big numbers,
Right. Much larger.
much larger
than
numbers.
72.
They're like, man, we are in high cotton here. We're going to be
We're gonna be
okay.
set. Right. Exactly.
Well, it's not reality.
Mm-mm.
Not even close. So let's go in and let's take 19. We'll use you can keep it here. Jake, over rate of return. See where it says 37.14? I want you to go through and every year that it's greater than 7.5, put 7.5. Every year it's under 7.5, leave it. Okay. All right. So we took a little pause there, and here's what I had Jacob do, Cody. I said, let's take the illustration, and let's do what they said was going to happen in the S&P 500.
Right.
Every year that the S&P was up, we capped it at 7.5%. Now, the insurance company's telling us that that could change from year to year,
Right.
but we assume best case scenario, we get 7.5%, and then every year the stock market was negative, we did 1. That's one we got to fix right there. Make that 1. There we go. So with a $72,000 cash surrender value, and we're putting in $3,600 a year to age 88, that net return would be 5.79%. And we should have $1,243,827 inside our policy.
Right.
So if the cash value goes higher than the death benefit, what happens to the death benefit?
Goes down, right?
No. Think about this for a second. If I got $1.2 million in cash, but my death benefit I bought was only $605, what happens?
It goes up.
Yeah. I'm going to get the higher of the two.
Yeah.
And my mortality cost is going to go down.
Right.
Because it's my cash.
Right. Yeah.
Right. So what's the net amount at risk to the insurance company? Should be 0.
Right. Because
there's no cost.
Yeah.
Well, if that would have happened, why is it? Let's go back to their illustration now. What the hell? I want to cuss here. This really pisses me off.
Yeah.
What happened?
Where did it all go?
I'm the agent. And I'm going, what the hell happened here? Where's the money?
Yeah. Where did it all go?
Well, let's go back and read the definitions. Let's go back and read what happened. Right here. Monthly deductions. Each monthly deduction consists of monthly cost of insurance, the monthly policy charge, the per unit charge, and charges for additional benefits provided by riders and any charges for substandard rate class. Well, he didn't have a substandard rate class. He got preferred.
Right.
We can see it up there, back when he was 31 years young. So, and by the way, this policyholder never took a loan.
Right.
He didn't borrow
it
to
alone.
pay his premium. He didn't do any of that.
Right.
And this thing is falling apart. So let's look at a definition. COI, the amount the company charges for providing life insurance coverage under the base policy. The cost of insurance rates may be changed by who?
The company.
The company. Any change in cost of insurance rates will be on a uniform basis for the insureds of the same class. So for all the premium policyholders.
Right.
And what they're showing us in this illustration is their current charge.
Right.
For all 31-year-olds who are now 49-year-olds. And all the way out to their 80s.
Right.
So they didn't ever change the charges. This is the current charges.
Right.
So we don't know what the future charges are going to be, but I know what the current charges are. It doesn't look good. Something is fatally wrong here.
Yeah.
And what it is that you're taking all of the risk that you were supposed to transfer to the insurance company.
Right.
And you as the consumer is assuming that risk.
risk.
You're assuming all of those costs of insurance risk. And the company, if they can change the rate, they will.
Oh, yeah.
But in this illustration, they didn't even change the rate. And the policy still lapses. And then they'll go back, well, there's a no lapse guarantee.
Yeah.
Well, help me figure the hell that thing out.
Oh, yeah. Whereas it lapse in every projection that we see.
Even their good projections.
Yeah. Lapse every time.
Folks, buyer beware. This is why the Bushes
Are in their situation. They didn't understand.
And I'm going to say this about the Bushes. I'm sure they're very lovely people. I'm sure they're just consumers like everyone. He's a race car driver. I'm not sure what Samantha has done for a living or if she, went to school and studied anything. He's a race car driver. He's not an actuary.
Mhm.
He's not a financial professional.
Right.
They went to people that they trusted. But folks, please read your financial documents.
Yeah.
If you have a question, if it feels a little weird, have your agent or financial professional explain it to you.
Mhm.
Help you understand it.
Right.
I want to sleep well with my clients at night knowing that I did well by doing good.
Right.
The reason I've avoided these type policies over the years is that I could not make heads or tails of how these things were designed.
Right.
They are, in my opinion, designed to fail, meaning they're designed to be like term insurance,
Right.
but they're being marketed as different. And they're telling you at the bottom of every page, please also see the values under the guaranteed projections and the description of the guaranteed elements in the narrative summary. And then they're saying, in case of non-payment of premium or insufficient premiums, the monthly deductions will continue to be applied against the cash value, and additional premiums may be required to keep the policy in force. Note about the non-guaranteed elements. Section I, the benefits and values are not guaranteed and are based on the company's current scale of non-guaranteed elements. The assumptions on which they are based are subject to change by the company. And 3, actual results may be more or less favorable. Most of the time,
Right.
less.
Right.
So, folks, if you want to be in the equities market, be in the equities market
Right.
and rent the insurance.
Mhm.
Buy term, invest the difference. If you want to buy life insurance and own it, one type, plain old dividend-paying, participating life insurance,
Right.
whole life,
Yep.
from one of 5 mutual companies.
Right. Yep.
Penn Mutual, Mass Mutual, Northwestern Mutual, Guardian Life, New York Life.
Yep.
I was like, oh
I
shit.
know. I was trying to jump
Got 'em
in.
all? Thank you.
Yeah.
I mean, those are the 5 companies I recommend to my clients. And Northwestern Mutual, by the way, I can't even write Northwestern Mutual because you have to be a captive agent there.
Really.
They're a little cultish. Oh, sorry, guys. It's their club, the way they
Right.
do it. But they're really good contracts.
Yeah.
Now, there's other contracts out there that are really good. There's a fraternity mutual out there called Navy Mutual Aid that I recommend a lot of my Navy clients buy their term insurance.
Yep.
I don't recommend they buy their permanent life insurance, not because it's bad. It's a really good dividend, really good contract. But most of the time, their policies turns into MEX, meaning they're overfunded too much in a way that can be also detrimental if you're trying to use the policy in the future as a retirement supplement or retirement strategy.
Right.
So the bottom line here for the folks who, in this case, that I think there's going to be a lot more attention because of this high-profile client
Right.
and how they've strongly come out in the media. And I can't blame them for taking the position they have and going, hey, Pac Life, we're going to shame you publicly for letting this happen to us. But it doesn't have to happen.
Right.
And I'll end today with saying this, Cody, I'm not sure they win.
Really.
Even as bad as this sounds for them and as bad as the agent did, these companies put it in writing for you.
They just didn't understand it.
Page after page after page, they're telling you, hey, this crap's probably not going to work.
Yeah.
I mean, I'm putting
Just
it in Kenny's
fancy,
English.
Yeah, in fancy words.
Yeah.
Yeah.
Yeah. You bought shit,
Right.
and you're going to get shit.
Mm-hmm.
Sorry for all my church friends. This pisses me off, and it makes me cuss. And
Yeah.
I wanted to say the F-bomb today, and I restrained myself.
That was
Your dad would be-
impressive. Yeah.
Your dad would be happy that I didn't do that.
Yeah.
So, folks, buyer beware.
Understand.
Understand what you're buying.
Yeah.
And there are some index universal life policies out there that could work. I haven't found one yet. So if you're an agent and you're watching this today, let's compare notes.
Yeah.
Come on my show.
We'll do it live.
Do it live. Prove me wrong.
Right. Yeah.
Tell me that this is
That it
the
worked.
only policy that your client should buy.
Right.
And prove it to me in my own. I'm putting you up to the challenge.
Right.
Come on my show. Educate me. I'm willing to be informed.
Yeah.
But you better be ready for a fucking fight.
Yeah.
Because I am not letting my clients buy this product.
Yep.
If I have anything to do with it, I'm telling them, you're taking risk. Insurance is supposed to be a transfer of risk. Let investments be investments.
Mm-hmm.
Let insurance be insurance. Investments is the acceptance of all risk.
Yep.
Life insurance, insurance in general, is the transfer of risk.
Yep.
I'm transferring the risk of my investments being my death benefit. I'm transferring the risk of letting my investments be all things to me when markets do go crazy.
Mm-hmm.
And when they do go down, and I promise you they will go down.
Right.
But we want to have places where we can have safe haven.
Yeah.
And safe, true protection and true benefits for us during our retirement phase,
Mm-hmm.
but also us in our legacy phase.
Right.
And I get it. The Bushes probably love their family very, very much, and they wanted to leave a tax-free legacy.
Yeah. They just didn't understand.
Kyle and Samantha, here's what I'll say to you today. Give me a call.
Yeah.
I'll show you how to do this the right way. But you know what you're probably going to do now is you're going to lump everybody in the same basket and say, you know, all are bad.
Right.
Life insurance is evil. Buying whole life, buying IUL, buying insurance in general is evil.
Right.
That's usually what happens is everybody gets thrown into the mix together.
Mm-hmm.
I've seen it happen in church life.
Oh, yeah.
I've seen it happen in financial life. Anytime somebody does something egregious as what's happened to the Bushes here, allegedly, we all get thrown out with the baby in the bathwater.
Yeah.
So, do you even know what that you love these things like tighter and Dick's headband, throwing the baby out with the bathwater.
I'm creating a running list.
A running list of my.
Yeah. Because I mean, I like them. I'm gonna use them.
Okay.
Whether I get them or not.
Right.
Yeah.
Be careful.
Might get me in trouble.
So, yeah, buyer beware.
Exactly.
This was just part B. I'm sure there's going to be more podcasts coming up here in the near future where I'm going to talk about this again.
Oh, yeah.
But, folks, if you have an IUL policy, get it reviewed by a professional.
Mm-hmm.
Get it reviewed by someone who didn't sell it to you.
Right.
Okay? And if you're one of my clients and you've bought whole life, and I promise you, a lot of my clients have done this, they'll go out and say, hey, review what Kenny recommended you buy.
Yeah.
And I'll stand behind it 100% of the time. There are good opportunities to buy permanent life insurance when it's just plain old dividend-paying permanent life insurance. Mm-hmm. Don't forget that, Cody.
Dividend-paying.
Dividend-paying, participating whole life.
Mm-hmm.
Stay away from this IUL stuff. And I'm going to have some buddies call me and go, KP, dude, you can't say it. Why are you doing that, man? You're hurting the end. No. I'm tired of seeing people get hurt by IUL.
Yeah.
Stop buying it.
Yep.
The industry will create another product, or they will improve this product to where then I could sleep well at night telling my clients to buy it.
Right.
Right now, Penn Mutual, one of my favorite mutual carriers, has an IUL product. I won't sell it.
Yeah.
I won't recommend it to my clients because it's too risky, and I'm supposed to transfer the risk for my client.
Right.
And there's not even a non-forfeiture agreement to do a reduced paid up. So if something changes their life and they can't pay premiums anymore, I can fix that.
Right.
Here, you're screwed.
Right. You're stuck.
So if you want to be stuck, buy IUL.
Yeah. That's moral of the story.
More of the story. Bushes, I'm really sorry this happened to you.
Yeah.
Hopefully you can get the support you need in court to rectify this for you.
Yeah.
But I think you got a big insurance company with big purse strings, and it's going to be tough. The old saying, a tough row to hoe.
That's a good one too.
Yeah.
I'll write that down.
All right, folks. Hey, we love you. Just wanted to share more information with you on buyer beware of Index Universal Life.
Yeah.
Have a great day. We'll see you on the other side very soon. Love you.
Wherever you reduce speed to 180.
Blackbox.